Welcome everybody to today's digital panel on sustainable finance. We are very happy as Holland Fintech to be able to be part of the Singapore Fintech Festival and to broadcast our session with you all today. First of all, really great initiative by Singapore Fintech Festival to bring the whole fintech community together in this week of great events. And the digital panel that we are bringing to you today is on sustainable finance regulations, compliance, and ESG adoption, where we are looking at the topic from a data and technology perspective. The companies and the experts who will be contributing their insights and their knowledge to you today are Investsuite, Synechron, and the Dutch Banking Association. And without further ado, I'm going to hand the word over to the moderator of the event today, who is Rajul Mittal from Synechron. So Rajul, whenever you're ready, feel free to take it from here. And I hope you all have a great event and have fun.
Yeah, thanks, Michael, and good afternoon to everybody who's joining from Europe and anybody else joining from other part of the world. Hello from all of us here. So today we have, apart from me, 3 more speakers. So I'll start with a quick introduction and then, pass on to the other, guests that we have. My name is Rajul Mittal. I work for Synechron for almost 11 years now, working in banking and asset management, across Europe. And for the last couple of years at Synechron, I've been busy with the topic of sustainable finance, where we look at the topic both from a regulatory standpoint as well as ESG. And I will be your moderator. The agenda for today is that, we start with an insight from our speakers. We cover both the ESG part as well as the regulatory part. And then we do a quick demo of a ESG booster that Synechron along with Investsuite has built. And post that, in the interactive discussion, we take up questions from you, any other questions that might be there, we have an open discussion. So feel free to, put in your questions in the chat and we'll try our best to answer that. With this, I'll pass on to Robert, just to, start with a quick introduction and then go to Investsuite. Yeah.
Thank you, Rajul. So my name is Robert Jan Prins, and I work as a policy advisor in the financial markets department of the Dutch Banking Association. And within that association, I'm secretary of multiple ESG working groups, so where banks get together to discuss regulatory topics. And on behalf of them, I will be joining today the discussion and the presentation, Rajul. I'll pass over to Chris now.
Thanks, Robert. Thanks, Rajul. My name is Chris Eichhorn, and I'm the Business Development Manager for Investsuite. Investsuite is in the digital investment space, and we are a 2.5-year-old company. And as Rajul mentioned, we've jointly developed a booster, and we'll be showing that a bit later. I'll hand it over to Maarten now for a quick introduction.
Yeah, hello. So I'm Maarten Wyns. Thank you, Chris, for the introduction, and thanks, Rajul and Roberto as well. So I'm Portfolio Optimizer, the product manager of Portfolio Optimizer at Investsuite. This is really the heart of a robo-advisor that we also have in the market. But in this case, we indeed have a co-creation with Synechron to build an ESG booster based on our optimization framework.
Thanks, Maarten. And I think what is interesting to understand is that Chris and Maarten bring to the table the technology aspect or the digital aspect, that we have put together in the ESG booster. And on the other side, we have Robert, who brings with him, the whole expertise and knowledge about regulation and how the financial industry, at least in the Netherlands, is looking at it. Yeah, so moving on. So I'll start with a quick introduction of, how we see sustainable finance. So what is the vision of Synechron when it comes to sustainable finance? I think the topic of sustainable finance has become more prominent and mainstream in, say, last 5 to 7 years. Definitely, it comes under the umbrella of the larger topic of sustainability that has been around for quite a while, but I would say in the last 20 years, it's gathered steam and attention from governments, from non-governmental bodies. And finally, what we see, say, in the last 5 years or so, also the consciousness of the larger public, is what we see. This topic is, catching attention. Within sustainability, I think sustainable finance is important, because if we need to have the desired sustainability shift that we as a planet need, we need to achieve a lot in a very short span of time. And within sustainable finance, there are two distinct pillars. So one is the regulatory pillar. So all the regulations that are coming to fore, be it EU taxonomy or SFDR, and I think Robert would dive deeper, especially into the SFDR and the MiFID II aspect of SF regulations. So that is important, and Europe, you can say, is taking lead, even though it's top down. So that is one distinct pillar. The second pillar of the whole sustainable finance is the ESG. So the data of the publicly available company, along the lines of E, S, and G. So that is there. But ESG is not really a regulation per se. It's a topic that is evolving, and it has its birth, say, as early as 1960s, where we had the first impact funds or responsible investing. And slowly, it has evolved over time. And if I remember correctly, the first time it kind of came officially to the fore was when Kofi Annan, if people remember, he was the UN Secretary General in 2004 and 5. He brought, a lot of this topic to the attention of the large corporates. So, but that is taking its natural course of things, and should be seen from a lens of evolution. But these two topics together are impacting the financial institutions in terms of reporting, risk management, investment, data management. And I think we're going to cover both these topics and look at how data and technology play an enabling role in terms of the whole shift. And so that is how we see the topic in a nutshell. You move further on a little bit. Thank you. So this still covers, say, the regulatory part of it. And I think the key message in this particular slide is that the regulation has been put in place, to achieve three goals. One is to reorient capital flows. So financial institutions are the parties where the money resides. And if the money starts flowing in the right direction, we can have a much faster shift in terms of the sustainability targets that we need. Secondly is to manage the financial risk. And I think that is also a part that Robert would cover, later on. And finally, what we see is that it kind of, brings together the regime of transparency and long-termism. And that especially, for example, a regulation like SFDR, that is what it does in terms of disclosures. So these are the three, key starting points why the regulation has been put in place. Yeah. So, yeah, and I think before I hand over to Robert to further dive into the regulatory compliance of sustainable finance related regulations, it's important to understand that, we have been seeing a lot of regulations, guidelines, initiative, or coming together of like-minded parties. But starting, say, earlier this year is where we see an exponential, shift in terms of either the deadlines or the initiatives. And in light of those two, of that shift, the two regulations that really come to fore are the SFDR and the larger regulation of EU taxonomy. So the time has come to act, not only proactively, on your own, but also looking at the regulatory regime. So I think in the next 2 to 4 years, we will see a lot of, movement in this direction. And with this, I would hand over to Robert to take us through, a little bit deeper in terms of the regulatory compliance aspect of sustainable finance.
Yes, thank you, Rajul. I will put on my slides on the screen. Just one moment to let me check how this works. I believe you see my screen now, right? Okay, great, thanks. So yeah, okay, great. So a brief introduction for those who are of you who are not completely familiar with the Dutch Banking Association. The NVB represents all commercial and semi-public Dutch and foreign banks in the Netherlands. So we have approximately 70 members in our association, and some of those are engaging in the investment industry, so in providing portfolio management or investment advice. So we are very much organized like a ministry of finance. Sometimes we have a board, we have all sorts of commissions, and we have working groups or expert pools. And one of these working groups is engaging on the topic of SFDR and MiFID II. And I serve as a secretary for these groups. And therefore I can provide you with some insights that we have on these two topics. So for my work, SFDR and MiFID II are key pillars of the Sustainable Finance Action Plan, and I will take you a bit more into detail in the next couple of slides. But other topics within the sustainable finance legislation cannot be seen in isolation. So the NFRD, this data we need actually to implement the SFDR in a proper way. The same goes for taxonomy. Once taxonomy reporting really starts, that will be integrated in SFDR disclosures. So we have to start now just because of timelines with SFDR. But as I will explain later as well, it would have been much more logical if we would have started with the NFRD and taxonomy so that we can disclose concise and comparable data. On the other hand, on the right-hand side of the slide, there are, of course, many other sustainable finance topics that touch upon SFDR and MiFID II, but that are a bit out of scope for today. For example, the review of IFRS reporting, the Dutch climate commitment that Dutch banks have agreed upon, or the Dutch Green Funds Directive, for example. So these interlink with SFDR and taxonomy and MiFID II, but they're a bit out of scope for today. So I would like to focus on the first two topics, namely MiFID II product governance and suitability and the disclosure regulation. So to start with the latter, I believe most of you are a bit familiar with the regulation, but in a nutshell, what do banks have to disclose? Well, they have to be transparent about the greenness of A, the firm, and B, the products they sell or make available. So that has to be done on multiple levels, I would say. First of all, on entity level, sustainability risk policies have to be in place. There also has to be a principal adverse impact disclosure. And without going too much into detail, the European supervisory authorities really believe that that only can be done with a lot of indicators. So that is not solely a qualitative report. It consists of maybe 30, 40, or 50 sustainability indicators. On entity level, there also have to be a change in remuneration. How is sustainability integrated into remuneration? Well, some firms obviously do that already. Other firms are maybe less compliant with that. But I believe within the Dutch environment, there is a cap on bonuses anyway. And I think that was actually the intention of the Commission with changing remuneration policies. So there have to be disclosures made on entity level, but also on a product level. And what is a product according to SFDR? Well, that could be an individual tailor-made managed portfolio. That could be an investment fund, but it could also be individual investment advice. So it's a very broad range of products that are in scope of SFDR. And well, we have analyzed this within the NVB. What are actually the requirements for all these different products? And it all starts with the categorization of these different products. Is the product super green, or is the intention of the product super green? So it aims for sustainable investment. Well, then it has to comply with so-called Article 9 requirements. Is the product's intention not super green, but does it promote ESG characteristics? For example, a longer list of exclusions. Well, then we could say that it might be an Article 8 product according to SFDR with subsequent reporting requirements. And there's also a third category, in our opinion, namely non-Article 8 or 9 products, which is a sort of a catch-all category. So we have the entity level disclosure and the product level disclosure. And then, very important and a big topic for my members, how do these disclosures align with our marketing communication? i.e., can banks still claim products to be sustainable if they don't qualify for the most green products under SFDR, namely Article 9? That is a big question, and we are not sure how that will turn out to go in the future. So just to touch upon some issues we have identified very high over. Definitions, these are unclear. So if I discuss with Rajul what exactly is an Article 8 or an Article 9 product, that cannot be made completely clear from the level 1 text. So there's a big chance we misunderstand each other purely because the definitions are very hard to distillate from the level 1 text. Furthermore, the timelines are non-aligned. So as I said earlier, it would have been very easy if we would have started this Sustainable Finance Action Plan with the Non-Financial Reporting Directive and with the EU taxonomy. So companies reporting this data, so the financial sector can actually use the data to report upon. That would have been the logical order of sequence, but it is not the case. It starts now with a disclosure by financial entities, while the companies don't have to report yet. And then data, I will leave the floor to Chris and Rajul later, because that's more your topic. But of course, there's a big data issue. I always call it everybody wants it, but nobody has it, because with different definitions, because of these regulatory flaws and different sources, so all these different rating agencies and different measuring methods, what data is actually correct and true according to SFDR? That's the question. And lastly, the consumer. So will he actually read and understand the additional paper load of information? And will these disclosures, who are being set up for the end investor, are they indeed comparable? Or will this lead to further greenwashing? Well, I think that question still has to be answered. And maybe the future will answer these questions. So that regarding to SFDR, I will just briefly touch upon MiFID II, another major topic for our members. So in a nutshell, what is expected of banks in the near future? Well, basically, we have to ask ESG preferences to clients. And if we have these preferences, we have to match them to subsequent products or portfolios. Well, that already happens, but then without ESG. So banks already ask in DPM for example, their ability to bear losses and their investment horizon, and then their financial position. But they also have to integrate ESG into that suitability test. And it's not enough just to ask clients, do you have ESG preferences or not? It has to be quite granular, the supervisors have told us. So that how far that actually goes is still unclear, but just some basic question is not enough. And it might be quite hard actually to match preferences of clients to subsequent products. So that's more a challenge for later. So besides the suitability test, there's also the changes in product governance, and that is more on the on DPM and advice, but also for execution only. So make sure that ESG is enshrined within the bank's distribution strategy. Banks now already have to think about what products do I put on my shelf and why, and for what target markets and what groups. Now they also have to identify target markets, for example, for specific ESG factors. And that will lead, in my opinion, to a big exchange of data between manufacturer and distributor. So some issues around these ESG preferences. As I mentioned, the extended data exchange between manufacturers and distributors, it could be quite challenging, because now with MiFID, that goes through the European MiFID template, for example, and that is not flawless as of now. So even without the ESG integration, we see that there are quite a lot of complications with this data exchange. Also, asking ESG preferences to clients might lead to client outfall. So you have to really do this in a smart and technical way to catch these client preferences, but not discouraging them in an online environment. And that is a fine line to balance upon, I guess. And furthermore, speak the same language with your customer. And I think, as the topic is quite complex, it might be difficult regarding information towards clients. There might be an information asymmetry. Banks or investment advisors have a big information gap to fill, and they have to educate their customers in a quite thorough way. So, Rajul, it might be good to discuss a bit of these topics, especially the data topic, during the panel later. So thank you for now.
Yeah, thanks, Robert, for very insightful, slides and information. And I think it also brings some people in the audience who have not really, dived into the topic up to speed before we start the discussion. So going back to the presentation that we had, so if we can have that, I would briefly try to explain, to get everybody up to speed, the ESG part and the data part. So I think most of you are familiar that ESG constitutes of the environmental aspect, the social aspect, and the governance aspect. Does it really contain these 3 or 4 metrics, under each category? That varies from literature to literature. But broadly, this is how it looks like. I think all of us are familiar quite a lot with environment. If we look at the social aspect, I think that has come, prominently to the fore, even during the Corona crisis. So a lot of emphasis of the governments and even the corporates is going to the social aspect. And I think governance aspect from an end client standpoint is still a little bit difficult to understand, because it could also mean corporate governance in a normal day-to-day basis. So does, issues like dividend and all that, do they fall under governance, or do they really fall under the governance as per ESG? So that is always, a challenge to understand, for the final audience. But this is what the ESG is about. So if we move on. So the introduction of the ESG data landscape. Robert already mentioned that we have no standardization or a single methodology when it comes to ESG data. So the data is quite fragmented, and that has to do with the fact that there are more than 70 providers of ESG data for the same company. For example, Apple as a company could have ESG data from multiple data providers that looks completely different. It could be a number from 0 to 100. At the same time, it could be a rating like a sovereign rating, AAA, BB, and so on and so forth. So it's quite fragmented and comes in different formats and languages. Yeah. We already have, seen greenwashing in the last decade. And if we leave it to the companies to publish their own ESG data without a singular methodology, then we have the risk of, greenwashing. And this is similar to what we saw during the Basel days, the Basel 2 and 3, that every bank needed to have their own risk methodology they could adopt before a standard was introduced. And there we saw that, many financial institutions adopted a risk methodology that was convenient to their, capital pool, or reflected the capital pool in a better light. So I think that is a key feature. So we cannot rely on the self-reported data when it comes to this. And what we have understood is that only a handful, or say 15 or 13% of the companies rely on in-house data management when it comes to ESG data. So a lot of them are partnering with third-party data providers. And we will see, later on, which are the prominent parties in this space. So further going on. So what we have noticed is that there's a lot of competition. I already mentioned more than 70 odd ESG data providers. So what we find in the market is that there are some new players who are specialized on certain kind of data. They could have a geographic coverage, they could have an asset class coverage, they could have a certain, mid-cap coverage, things like that. Then we have globally focused data providers only for ESG and sustainability, the likes of Sustainalytics. So those kind of parties. Then we have traditional market data providers, so parties like Refinitiv or Bloomberg, who have been for quite many years the leading parties, or Morningstar, in terms of data providing to the financial institutions. And finally, we have certain players who add a layer on top of the ESG data into the whole investment world and the analytics world. And so these are different flavors of data providers that we see in the market. Yeah. And I think the next slide, if we move on to the next slide. So this, what we have tried to capture is the prominent ESG data providers. And you can clearly see quite some difference in terms of either the methodology, So for example, if you look at Sustainalytics and Refinitiv, so Sustainalytics has a score 0 to 100, and it's a risk score. So 0 being the best score that you can get, or the minimum risk. At the same time, if you look at Refinitiv, it's 0 to 100, but 100 being the best score that you can get, So, and at the same time, if you have MSCI, which has ratings similar to sovereign ratings, AAA, AA minus, and so on and so forth. There's quite some difference in terms of the update frequency. So ESG data is not updated as frequently as we see the financial indicators. In fact, in most cases, it's only updated once or twice a year. So it's always lagging behind when it comes to financial data. So I think the key message here is that for us to have a regime, where the ESG data is standardized, structured, we are still quite far from that. So the next 3 to 5 years will be very interesting to look at how this market evolves, because and does the regulator make a choice in terms of either a singular methodology or the update frequency and other parameters that we see on this chart. So I think that we need to bear that in mind and see how the market evolves. So if we move on to the next slide. So what we did at Synechron is that we looked at S&P 500 companies, and again trying to drive the same message in terms of, how consistent is the ESG data. And we were able to, get data of around 420 odd companies. And based on that, what we see is that there are more than 11% companies which, according to us, have quite differing ESG data, and also another 48% companies which have moderately differing data. So close to half of the companies, based on 2 leading data providers, have quite a different ESG score, even if you normalize it. So that means that for an investment manager, and I think we will also see that same feature in the ESG booster that we will showcase later on, that for a company like, for example, Oracle, it could mean that for an investment manager, it has a very good ESG rating based on Refinitiv, but at the same time, Sustainalytics does not consider it very good in terms of ESG parameters. And I think that challenge keeps reoccurring, as we look more closely to the ESG data. So I think with that, if we move on, and I'm also careful of the time that we have. What we have tried to do, Synechron and Investsuite, to look at creating a platform or an accelerator which put ESG into perspective, and definitely for our clients who are just embarking on the journey in terms of which data provider to choose, what all you can do with ESG data. So that is what we try to showcase with the ESG Booster. If you move on to the next slide. I'll keep this brief because we will also try to do the live demo. The audience for this slide is quite wide, for this booster, ESG booster is quite wide. It could be investment managers, portfolio managers, it could even be retail banking, in terms of reporting. So that is what we can do. And the use case is that the booster, the ESG booster, is data provider agnostic, at least considering the leading data providers. And it tries to put into perspective, for example, for a private banker, where either DPM or any other portfolio that you have, we're able to calculate the ESG score at the portfolio level and try to showcase what all you can do in terms of, looking for alternatives that might be there in the portfolio. So with that, I would try to share my screen and go to the booster. Maarten and Chris, something you would like to add here in terms of your experience with jointly building the ESG booster?
Yeah, I can say a few words, Rajul, or maybe since you have the booster set up here, it's best to go through it, and then I can add a few words of context a little bit from the technology perspective. So first we'll look at this exact example, and then we can come back to a little bit more of the context from a technology perspective, where this fits in and on our side.
No, for sure. Okay.
Okay.
Let's do it like that.
Sure.
So also bearing in mind, we'll try to keep it short. This is the landing page of the booster. What it does is that you can upload any portfolio. It could be an equity portfolio. Currently it was for equity. We are extending it to, funds as an asset class as well. And that should be ready sometime in January. And I think before I dive deeper, I would like to mention that, this is to show the power of possible. What all you can do with ESG rating, and different components can be integrated in different parts of, say, a given bank or an asset manager or a portfolio management company. So this portfolio that we see consists of 25 equities, and what you see on the screen is 54.46 is the ESG score of the portfolio. And when we talked about being data provider agnostic, so currently this data is based on Refinitiv, which is a leading ESG data provider, but also the publicly available data on Yahoo. So if we change, say, the data provider, the whole portfolio score changes, because this in turn uses the Sustainalytics data, and where 0 being the best score. So you do see already the challenge in terms of having consistency around the different data providers. We talked about the outliers and the S&P 500. So what we did is that for this particular portfolio, we looked at both the data providers that we had, and the dots that we see in red are the companies that we think have a big or huge outlier score, and they have quite a varying score across the two data providers. And then the analyst of a given asset manager has to closely investigate why this discrepancy is coming into picture, because we do not want to have something in your portfolio which, according to one data provider, has a very good ESG score, and that drives your ESG score and your reporting much higher. But at the same time, the other ESG data providers in the market do not consider it as good as the first data provider. What you can also do in this is compare your portfolio to the other leading indexes or benchmarks in terms of ESG score. Not only the total ESG score, but the E, S, and G score. And if you want to look at a particular company within the portfolio, you do see the underlying ESG score, also the different metrics in the E, S, and G. And we have also integrated the news part, and why this is important is because the ESG score is only getting updated once or twice in most cases. So what would be very interesting is to see, are there any major news events that might have impacted the ESG score or potentially can impact the ESG score. And with that, I would go straight to one of the key features of this booster. So here on the chart, you see the 25 companies that we have. And all the companies which are dragging the average score down are depicted in red. And the one that have a slightly higher score than average are in green. And for any asset manager, you would want to constantly improve your ESG score. And that's where the whole partnership with our partner Investsuite comes into picture. So, for example, if we want to replace Qualcomm and Oracle, we do this, and then Maarten or Chris, you would want to come in and explain what it does in the background.
Yeah, sure. Thanks, Rajul. So indeed, this is where the partnership with Investsuite comes into play. So the approach we apply here is that we want to keep your portfolio as close as possible to your original portfolio. So not only in terms of financial performance, but also in terms of asset allocation, so regional allocation, sector allocation. I think this is also something you can see indeed when you press the portfolio versus the current portfolio versus the proposed portfolio. So we keep in mind the sector allocation, the regional allocation, the currency allocation, and we put boundaries on that. So we really optimize the portfolio by saying that your new portfolio has to look like your current portfolio, but the ESG aspect of your portfolio needs to be boosted, of course. So this is also what you see here. The original portfolio had an ESG score of 54, and I think it went to over 60. So we do to 63 in this case. So the thing we do here is we do two simulations or two optimizations in one. We boost your ESG score, and we also try to track your original portfolio, let's say. And in the latter part, there really our technology plays a very important role because we use our own measure of risk there. So that's called IVAR, and IVAR is like a replacement, let's say, of, for example, volatility. A lot of optimizers still work with volatility, but volatility has some known issues. For example, it assumes that the distributions are normal. They don't capture tail risk and all those things. So by using our own measure of risk, which is called IVAR, we take into account drawdowns and time to recovery. So these two aspects, which are very important to investors, drawdowns in the portfolio and time to recover from those drawdowns. So these are the things that we take into account in our risk measure, and hence also in our optimization. And by combining this with the ESG aspect, you really see that we are able to closely match the original portfolio. So on the blue line, you see the original portfolio, and on the green line, you see the proposed portfolio that has a better ESG score. And by focusing on limiting the drawdowns and by focusing on getting the time to recovery good, you see that even the proposed portfolio is able to outperform the original portfolio and improve the ESG score at the same time. So we really think that this is a very powerful tool for example, advisors. But of course, as Rajul already mentioned, this is only one of the use cases that we can handle. Our portfolio optimizer is very flexible in terms of universe types of assets. As Rajul was mentioning, we are also working on including mutual funds or ETFs. So that's all things that are possible. You as a client could boost the ESG score, but also other scores for example. So here we're focusing really on the total ESG score, but we could focus on carbon emission as well, of course. That are all things that are taken into account. And maybe one last thing to mention from our perspective, so from technological perspective, when we do improve the ESG score of the proposed portfolio, we also take into account the sub-scores. So we don't want that the total ESG score is improved, but for example, you see a huge drop in social score. This is something we don't want, and that is also taken into account. And yeah, that's all flexible. These are all parameters that can be changed according to the needs of the client, let's say.
Thank you, Maarten. And I think, as you can also see, and Maarten already we do not only optimize on ESG, but you can also optimize on the E, S, and G score. Looking at the time, I think we would now go back to the discussions and the questions that we have from the audience. And Robert, looking at you, what do you think of this? Because this does highlight, say, the main challenge, and you also talked about, say, the client fallout, because if you introduce client ESG preferences, but there is no uniformity in the market, then, if I switch from, say, for example, ABN AMRO to ING, and the questionnaire and the kind of information that is being asked is different, then that leads to a lot of confusion and, lack of knowledge.
Definitely. I think that's where the supervisory authorities are looking for, comparability and transparency. But in all honesty, in the short term, I don't think we'll manage to come over that without the data from the source. So without data stemming from the NFRD or the taxonomy, I think it's a blue sky scenario to reach comparability and full transparency in the short term. But technology obviously can help. And like Maarten and Chris and you showed on a portfolio level, I think that is very interesting. And would become even more interesting if you match that portfolio to the client preferences. So a client has strong preferences for, I don't know, exclusion of automotive industry, or has a strong focus for the E instead of the S and the G. If you could match and plot that against the portfolio, that would be very interesting indeed.
So I think in the same breath, what we have been discussing together with Investsuite is also that for the underlying parameters of E, S, and G, we are able to further provide a booster. So for example, for a particular client, the carbon emission is very important. So in that case, we would give, say, a certain more weightage to the optimization of carbon emission. So we are already, considering that. But my follow-up question would be, and that I keep coming across, in my discussions with different financial institutions, that for the end client, ESG is something that is to do with investments, at least so far. For many of the end, retail clients or even private clients, UN SDGs or the Sustainable Development Goals, that is something that they see more often either on the news or on the social media and things like that. So how do we bridge that gap, say, in terms of knowledge from the UN SDGs to the ESG?
Is that a question to me?
Yeah, just question or just your views, on the whole topic of bridging the gap in terms of knowledge from the UN SDGs to ESG? Because, you know, yeah.
I think it's quite remarkable that in the regulations, SDGs are barely mentioned. So in the SFDR, I don't think there's a single reference to SDGs. In MiFID, there's no single reference to SDGs. So their focus is somewhere else. I can imagine that financial entities would like to talk with clients on SDGs. But when it comes to portfolio and mapping client preferences to a portfolio, I think there's a world to win still regarding asking these SDG preferences and actually plotting them towards a portfolio. I think it will be easier to do that on the basis of ESG, for example, linked to Sustainalytics and Morningstar and Refinitiv ratings.
No, I think that's a fair point. And the reason I ask is that based on at least my discussions with the various financial institutions, one is that they have done a study with the end client, and for the end client, still UN SDGs is a more familiar term than ESGs. And secondly, also on the corporate side of banking, many banks are considering the self-assessment of corporates in terms of sustainability. So even if you look at the annual report of many of these financial institutions, they do not mention ESG as targets. What they do mention is that, okay, out of those 17 SDGs, these 3 SDGs have our priority. So, it's already a little bit more embedded. And that was the reason, it keeps coming back as the interoperability between the UN SDGs and the ESG as a topic. Yeah.
Yeah, I think there's also an important thing indeed on that is important for client reporting, because in general we see that end clients, even the UN's goals, they often don't know about, and the regulation, the bridge between regulation and what the end client feels and looks is very different. So there, I think in client reporting, it should be really tangible. It should be really tangible for the end client to see how is my portfolio doing in terms of ESG, but without using those exact terms. If you put there a raw ESG score or whatever, then that doesn't mean anything to the client. And that's also where at Investsuite we try to aim for with our storyteller, where we generate automatic reports. So we generate automatic reports in a human reading that are readable for a human, normal human, let's say. So it's really a text report that reads like a story, that reads like a tale. And there we also use these tangible concepts like carbon emission and waste that are really explainable to a broad audience. So there, I think, and we think from Investsuite, there is still a long way to go to bridge that gap, let's say.
Thanks, Maarten. And I see some questions from our participants. So one of the questions is, how do you measure and report on ESG readiness at the client level? Anybody wants to take that before I give my take on this? So how do you measure and report ESG readiness at the client level?
I might jump in here, Rajul. If I understand from Gabriel correctly, it goes back to one of the things that Robert talked about, which is to get the preferences to be very human focused and understand what people would like from an investment perspective, and to speak the same language as the customers as well, so everybody's aligned and not discouraging the customers and getting their input. And I think from a technology perspective, we see this as a priority, of course, when we're doing the onboarding, to understand exactly what clients would like to have from an ESG perspective, if at all, in their preferences with respect to the investments. And therefore, we can get some idea if they're ready for this or not, if they're asking for it. We have prospects in Central Europe, for example. We're a B2B company, so the prospects, I'm talking about banks, wealth managers, pension funds, asset managers, and a lot of them in Central Europe, they say, Nobody's asking for this yet. I make it very black and white, whereas all of our prospects in the Nordics are asking for this for a long time, and even challenging us as a company. Do you have these different ways of presenting the ESG scores? Can you bring the storyteller in the form of a video, for example? We heard from one of the major Nordic players. And so it varies region by region. And we're getting feedback right and left about what the preferences are from these different regions and the customer readiness there, and then how we can address those needs in our technological solutions.
I think that's a very interesting remark, Chris. And what we also see in terms of ESG readiness across the globe, that definitely the Northwestern Europe is taking a lead in it. Yeah. And I think till 2015 and 16, even though the topic was a little bit more nascent, US was not far behind. But with Trump coming to the White House, is where we had a complete break, for the US transitioning towards ESG or, the Paris Accord. Thankfully, if he leaves the office on 20th of January, we might see US coming back to the bandwagon. And I think that's good for the planet. But I think the last remark, coming back to Gabriel's question, there is also only a limited mention of, say, ESG when it comes to the SFDR regulation as such, And I think companies have to do a little bit more than the regulation. And for that, we have to, see how this evolves. So there is no single template that we can measure the readiness of a company, in terms of ESG. And I draw a parallel to what Robert has said earlier, because I was very busy with the topic, earlier regulation called PRIPS, where you had to have a standard key information document with defined sections. And I think unless we have that kind of standardization, say in the next 3 to 5 years, it will be very difficult for all of us to measure, say, the ESG readiness. Robert, you want to say something on this?
Well, regarding the question on ESG readiness, I think you have to separate several levels. So firstly, does it concern a retail or a professional client? Obviously. And second, is that assessment being made online or offline? So in the professional industry, of course, you have face-to-face conversations with very professional counterparties. But if you encounter a retail client that will be onboarded online, it will become very hard to measure his or her ESG readiness, very granularly, as the regulators and the authorities expect us to do. And actually, even without ESG preferences, we think it's quite difficult to completely measure a retail client's financial position or ability to bear losses or investment horizon. And if you add very complex and technical factors of ESG into an online environment, that will become very difficult.
Indeed. Moving on to the next question, and there are two questions from Sarah. And the first one is that the SDGs are more linked to companies than portfolios, and I think that's a fair remark, to make, that it's more related to companies. And I think SDG goes wider than the companies. It's also about the government. How do they see this topic, shaping up? And ESG is more focused on, say, the corporates and the investment world. So that is a fair remark. But the question Sarah has is, and I think, Robert, that is for you, did you use regulated data that are compliant, for instance, with the taxonomy? So when we talk about, say, ESG data, are we already using data that is compliant with taxonomy?
Well, I think most of the delegated acts of the taxonomy are not applicable yet. So I think it's very hard for parties to already incorporate taxonomy. But once all these sustainability rating agencies will use data stemming from the NFRD and the taxonomy, well, you guys can make use of that in your environment, because the data from these agencies directly feeds into, for example, the product you just showed, right? So for now, I think it's a bit too early to say that we use all the taxonomy data because that data is still not here. But once sustainability rating agencies use that data, you guys can use that as well.
But we still do not see or envision that the taxonomy, at least in the next 1 year, is going to give definitive answers when it comes to ESG definition. So ESG definition and how the data is compiled, that is still would be all over the place, you know.
Yeah, I agree, but there is no solution to that, and that's why the plans of the European Commission and the authorities are so ambitious, but necessary.
Yeah. The final question, because we are like, you know, close to winding up the session in 4 minutes. So the final question we have from Kamar Hussain, if I pronounce the name correctly, where do you see the demand going forward in the context of human capital and the requirements of institutions for talent to focus on the ESG space? Anybody wants to take that, or should I give a shot at that one?
You give it a go, Rajul.
Yeah, thanks, Robert. I think, as we said earlier, that the topic of sustainable finance as large, both the regulatory part and the ESG, has become mainstream now, you know, and for one reason or the other, to either mitigate risk or be compliant or, you know, also see opportunity, financial institutions have to start moving, or they are already moving. So I personally believe that at least for the coming decade, so this would be the decade of sustainable finance, ESG investments, regulation related to sustainable finance. And we would need a lot of human capital in terms of either compliance, analytics, data, technology, and even by these data providers, you know, to really increase their coverage, not only in the Western world, but go towards the emerging market. Because say, for example, India and China are major economies, and we still do not have any form of ESG data from companies which are, you know, competing with the S&P 500s, and, you know, a major source of you know, either pollution or supply chain issues, you know, and so on and so forth. So I think there is a huge demand for human capital. I think with this, we have answered all the questions, and also looking at the time. Chris, Robert, and Maarten, any last words before I hand it over to Michael to wrap it up?
I might say one more thing, because you touched upon the United States, and I think one of the issues in the United States from an ESG is the performance of the ESG funds. And so we've talked a lot about, and in the booster, the performance of the ESG aspect of the portfolio. And I think it's a very interesting element also is, do ESG focused funds perform better than their counterparts which are not ESG focused? And I think when you bring it back to the technology perspective, and maybe just the last word here is that also the technology needs to come back, and this is what we focus on very much, is the optimization, and to make sure that the investment performance and the investment return from a money basis, which is always pretty much key for everybody, of course, the ESG is a nice to have, is still performing, and is even better than if it's not ESG focused. So we didn't talk about that too much here, so I wanted to just add that one more element.
Thanks, Chris.
Sure.
So shall I hand it over to Michael for the wrapping up of the session? Robert, anything you would like to add?
Rating, Rajul.
Thanks for you know, joining and making this a success.
Thank you very much, Rajul. Thank you for moderating the session today and sharing your insights, and also a big thank you to Robert Jan, Maarten, and Chris for contributing to the topic, and from the perspective as an expert, sharing us what your vision is, where the market is heading and where the market is now. And I think we can all agree that the market is not exactly where we want it to be yet, but it definitely is progressing, and we're all doing our best to make it get there as soon as possible. So great, and thanks for sharing your insights. And of course, thank you for Singapore Fintech Festival for allowing us to broadcast this session today. And thank you for everyone attending. I hope you thought it was insightful. Just before we leave, One small note, we are organizing the Holland Fintech monthly meetup, which is starting right now. So everybody who is interested in joining in, it's free to join. You can join by visiting our website, going to the events section, scrolling down to the meetup and joining the link that is published there. If you're wondering what is the meetup about, the meetup, we do it every month where we have 4 to 5 pitches from companies in our network. We have a pub quiz to test your fintech knowledge as well. So basically, it's a nice way of bringing the fintech community together on the Friday at the end of the week. So finally, once again, thank you Singapore Fintech Festival for having us, and I hope to see you all at the Holland Fintech Meetup in a minute. And thank you for tuning in, and have a great day. Bye-bye.